In this session, we're going to talk about asset revaluation, what it is, why it happens, and how it works in practice. Forget accounting standards for a moment. Let's focus on the idea first. Asset revaluation means updating the value of a long-term asset to reflect what it's worth today rather than what it cost in the past. Over time, the value of assets can change. Buildings go up or down in value. Equipment becomes outdated. Markets change. Revaluation usually applies to non-current assets which the business uses over a long period. Typical examples include land, buildings, and plant and equipment. Asset values can move in two directions, up or down. An increase in value is called an upward revaluation. A decrease in value is often referred to as a downward revaluation or an impairment. What's really happening in upward revaluation? Let's say a building was bought years ago and is now worth much more. The business hasn't sold the building, no cash has been received. So even though the asset is more valuable, the gain is unrealized. That's why upward revaluations are not treated like normal income. Instead, the increase is shown separately, usually in equity, not a trading profit. Let's see how upward revaluation works in practice. Business bought a building years ago for $400,000. Accumulated depreciation to date is $100,000. Carrying amount or net book value before revaluation is $400,000 minus $100,000 equals $300,000. An independent valuer now says the building is worth $500,000. Step 1. We work out the revaluation increase. Current carrying amount is $300,000, revalued amount is $500,000, upward revaluation is $200,000. Step 2. What has not happened? The building has not been sold, no cash has come in, no customer transaction has occurred. So this $200,000 is an unrealized gain. It exists only on paper. Step 3. Because it's unrealized, the gain does not go to profit or loss. Journal entry is debit property, plant and equipment $200,000 and credit revaluation surplus. Step 4. How the accounts look after revaluation. In the balance sheet, non-current asset building is $500,000, equity revaluation surplus is $200,000, profit for the year is unchanged. The increase is not income, it sits in equity, not profit. It's labelled separately as a revaluation surplus, so accounting keeps it out of profit to avoid overstating performance. An upward revaluation increases the asset's carrying amount, but because the gain is unrealized, it is recognized in equity as a revaluation surplus rather than in profit or loss. In this section, we're going to talk about downward asset revaluation, which is more commonly known as impairment. Impairment occurs when an asset's carrying amount is higher than the value that can be recovered from using or selling it. In such cases, the asset must be written down so that it is not overstated in the accounts. Indicators of impairment include damage, obsolescence, poor performance, or changes in market conditions. When these indicators are present, an impairment review is required. To calculate impairment, we first look at the asset's carrying amount, which is the value shown in the accounts. We then compare this with the recoverable amount, which means the maximum value the business can get from the asset, either by using it or by selling it. If the carrying amount is higher than the recoverable amount, the difference between the two is the impairment loss. This journal entry recognizes the impairment by recording a loss in profit or loss and reducing the carrying value of the asset in the balance sheet. Future depreciation is recalculated using the new carrying amount and the remaining useful life. Let's now look at downward revaluation or impairment loss in practice. The company owns a machine. Cost of machine is $100,000. Useful life is 10 years. Residual value is 0. Depreciation method is straight line. Annual depreciation is $10,000 per year. After 4 years, the accumulated depreciation is $40,000. Carrying amount, or net book value, before impairment is £60,000. Due to technological obsolescence, the recoverable amount of the machine is assessed at £45,000. Because the carrying amount is £60,000 and the recoverable amount is only £45,000, we must recognise an impairment loss. Impairment loss is £60,000 minus £45,000 equals £15,000. Impairment is recognised as an expense in profit or loss. Some companies credit the asset directly, others use a separate accumulated impairment account. The effect is the same, the asset's carrying amount is reduced. After recording the impairment, the new carrying amount of the machine becomes £45,000. This is the new revalued amount, and this is the figure we use going forward. Now we must recalculate depreciation based on the new carrying amount and the remaining useful life. Original life is 10 years. Business used 4 years. Remaining life is 6 years. Depreciation will now be £7,500 per year. Notice how depreciation decreases after impairment because we are depreciating a lower asset value. Asset revaluation rules depend on the accounting framework. International financial reporting standards and UK generally accepted accounting principles allow revaluation, while US generally accepted accounting principles is much more restrictive. Under international financial reporting standards, assets are initially recorded at cost. After that, a company may choose either the cost model or the revaluation model. Revaluation is optional, applies mainly to property, plant and equipment. Assets are revalued to fair value. Revaluation can be upward or downward. Upward revaluations go to revaluation surplus, equity. Downward revaluations are treated as impairment losses. Future depreciation is based on the revalued amount. UK generally accepted accounting principles follow a similar approach to international financial reporting standards, but is simpler. Assets are initially recorded at cost. After that, a company may choose either the cost model or the revaluation model. Revaluation commonly applies to property, plant and equipment. Assets are revalued to fair value. Allows both upward and downward revaluations, provided they reflect fair value. Upward revaluations go to revaluation reserve, equity. Downward revaluations are treated as impairment losses, recognised in profit or loss, unless they reverse a previous revaluation surplus. Future depreciation is based on the revalued amount. Under US generally accepted accounting principles, assets are measured using a historical cost model. Unlike international financial reporting standards and UK generally accepted accounting principles, asset revaluation upward is not permitted. Assets continue to be measured using the cost model only. Revaluation commonly applies to property, plant and equipment. Assets are reviewed for impairment when indicators exist. Downward revaluations are recognised in profit or loss. Impairment losses cannot be reversed. Upward revaluation is prohibited. Depreciation is recalculated using the reduced carrying amount. This table highlights the key differences in asset revaluation, particularly the treatment of upward revaluation and impairment under each framework.